Okay, so you wanted the inside scoop on the Fed's latest move. Buckle up, because we're deep diving into their September 18th press release. And trust me, this isn't just another dry financial report. This announcement gives us a major clue about whether we're on track for that soft landing everyone's been buzzing about, or if we're in for a bit of economic turbulence.
What's really interesting here is that the Fed decided to lower interest rates, which usually means they're trying to give the economy a little boost. But here's the twist. It wasn't a unanimous decision. One Fed member actually voted against it, which always adds an extra layer of intrigue, wouldn't you say?
Absolutely. It's like finding out there's a plot twist you didn't see coming. And that's what we're all about here, unpacking those twists and turns and figuring out what they mean for you. Because let's be real, these interest rate changes aren't just numbers on a screen. They directly impact your financial life, from what you pay for a mortgage to how much your savings might grow.
Exactly. It's like a ripple effect. Think about it this way. When the Fed lowers interest rates, it's like gently encouraging people to borrow and spend more. This can lead to lower interest rates on loans, making it a bit easier to buy that new car, or finally tackle that home renovation project you've been dreaming of.
Okay, so let's dive into the actual press release, shall we? Right off the bat, the Fed says that economic activity has continued to expand at a solid pace. Now, we know the Fed loves their carefully chosen words. So what are they really trying to tell us with this solid pace business?
Well, they're walking a tightrope, trying to project optimism without ignoring the economic realities. Think of it like this. They're saying the economy is in decent shape without giving it a full-blown, clean bill of health. They're acknowledging that things aren't perfect, which is important because we have seen some mixed signals lately.
Speaking of mixed signals, they also mentioned that job gains have slowed. That doesn't exactly sound like a reason to break out the champagne, does it?
No, it doesn't. But in typical Fed fashion, they immediately follow that up by saying the unemployment rate remains low. It's like they're trying to soften the blow. The job market is still holding up, but it's not quite as strong as it was a few months ago.
It's a balancing act for sure. They're trying to keep the economy moving in the right direction without letting things get out of control.
Precisely. And of course, the elephant in the room is inflation. The Fed tells us that inflation has made further progress towards their target of 2%, but remains somewhat elevated. They're trying to reassure everyone that they've got this whole inflation thing under control. But those words, somewhat elevated, tell a slightly different story, don't they?
It's like they're trying to calm a nervous friend, saying, everything's fine, really. But you can hear a hint of uncertainty in their voice. And this is where that dissenting vote becomes really interesting.
Exactly. Because if they were completely confident about inflation, you'd think the vote would have been unanimous, right? But the fact that one Fed member disagreed and wanted a smaller rate cut suggests there's some real debate happening behind the scenes about how much breathing room to give the economy right now.
It's like a sneak peek into the internal struggles of the Fed. And you know what they say. Where there's smoke, there's usually fire.
It definitely adds a layer of complexity. And we're going to dissect that dissenting vote in just a bit because it offers valuable insights into the different perspectives within the Fed.
And that's exactly what we're here for, right?
Yeah.
To unpack these complex issues and give you the knowledge you need to navigate the financial waters. Okay, so we've got this internal debate within the Fed, a cautiously optimistic economic outlook, and inflation that's being a bit stubborn. Let's zero in on that dissenting voice for a moment, because I think it reveals a lot about the dynamics at play.
It's like getting a glimpse behind the curtain, isn't it? Michelle Bowman, who voted against the rate cut, is known for being particularly concerned about inflation. What's fascinating is that her dissent tells us that at least one Fed official believes they need to keep a tighter rein on things, even if it means potentially slowing down the economy a bit.
So let's play this out. If they had gone with her suggestion of a smaller rate cut, what kind of message would that have sent to the markets?
It would definitely signal a more cautious wait-and-see approach, almost like saying, we're not convinced inflation is fully under control yet, so let's not get ahead of ourselves.
Yeah.
And these kinds of divided votes can create some uncertainty because investors hang on every word from the Fed, trying to anticipate their next move.
It's all about managing expectations.
Right.
It's not just about the actual numbers. It's about how the markets perceive those numbers and the Fed's actions.
Absolutely. The Fed is constantly trying to guide the economy in the right direction without causing unnecessary panic or volatility. And remember, they're always thinking several steps ahead, like a grandmaster in a game of chess. They're not just reacting to the current state of the economy. They're trying to anticipate what might happen down the road and make adjustments accordingly.
So they're not just steering the ship. They're trying to predict the weather, navigate around potential storms, and make sure everyone on board feels reasonably confident.
Exactly. And speaking of navigating, let's demystify some of the tools the Fed uses to steer the economy. We often hear terms like open market operations and the federal funds rate. But what do those actually mean in practice? How do they actually work?
Right, because it's easy to get lost in the jargon. It's like they're speaking a different language sometimes.
It can feel that way, for sure. So think of the federal funds rate as the interest rate banks charge each other for very short-term loans, basically overnight. It's the benchmark rate that influences all sorts of other interest rates in the economy. But here's the thing. The Fed doesn't just snap their fingers and set this rate directly. They influence it through these things called open market operations.
Okay, open market operations. That sounds very official and kind of mysterious, like something out of a spy movie. Break it down for us.
It sounds way more complicated than it actually is. Imagine the economy is a swimming pool, and the Fed is trying to keep the water at just the right level. Too high, and you risk it overflowing, inflation. Too low, and you can't really swim, recession. Open market operations are like the Fed adding or removing water to maintain that perfect balance.
I like that analogy. So how do they actually add or remove water, so to speak?
They do this by buying or selling U.S. Treasury securities in the open market. If they want to lower interest rates like they did with this recent announcement, they'll buy Treasury securities. This injects money into the system, making it cheaper for banks to lend to each other, which then trickles down to you and me in the form of lower interest rates on loans.
So it's all about supply and demand. More money in the system generally means lower interest rates.
Precisely. And if they need to raise rates, they do the opposite. They sell those Treasury securities, which removes money from the system and makes lending more expensive.
And the Fed has been pretty active lately, haven't they? First, they were raising rates aggressively to combat inflation, and now they're starting to ease up a bit. It begs the question, what will their next move be?
That is the million-dollar question, isn't it? And that's what makes following the Fed so fascinating. It's like watching a high-stakes game of strategy unfold in real time.
And just like any good game, we know there are always surprises in store. So while we can analyze the past and try to predict the future, we're all ultimately along for the ride when it comes to the Fed's decisions. But knowing how to read the signs and understand their moves can definitely make the ride a bit smoother.
Couldn't agree more. The more you understand how the Fed operates and what factors influence their decisions, the better equipped you are to navigate your own financial journey.
All right, we've covered a lot of ground here, from the Fed's rate cut and that intriguing dissenting vote, to those mysterious, but not really, open market operations. But let's bring it all home. Is the Fed winning its battle against inflation, or are we stuck on this economic roller coaster for a while longer? What do you think?
That is the million-dollar question, isn't it? The honest answer is, it's still a bit early to say for sure. Remember, the Fed itself admits that inflation is still somewhat elevated, but they're also projecting this air of confidence. Like they're certain their actions are steering us in the right direction.
They're like a poker player with a carefully crafted poker face. Trying not to tip their hand too much. But we know they're laser focused on those inflation numbers.
Scrutinizing every decimal point. Exactly. And they're looking at a whole range of economic indicators, not just the headline inflation rate. Think of it like a doctor checking your vital signs. They're analyzing things like wage growth. Are salaries keeping pace with inflation or falling behind? They're looking at housing costs. Are rents still skyrocketing or are they starting to cool down? They're even trying to gauge consumer expectations. How confident are people feeling about the economy? Are they still worried about inflation eroding their purchasing power?
It's like they're piecing together a giant economic puzzle, searching for clues wherever they can find them. So based on all those puzzle pieces, what's their crystal ball telling them about the economic outlook in general?
Well, as always, they're very deliberate with their language. You won't catch them using words like recession or downturn, but they are acknowledging that the economic outlook remains uncertain, which in Fed speak basically means we're cautiously optimistic, but buckle up, because things could still get bumpy.
Translation, don't throw away your rain boots just yet.
Precisely. But here's the important takeaway. Knowledge is power. The more you understand how the Fed works and what motivates their decisions, the better prepared you'll be to navigate your own financial journey, regardless of what twists and turns lie ahead.
Absolutely. So let's bring it down to a personal level. What does this latest Fed announcement mean for you and your wallet? What should you be thinking about right now?
Well, for starters, This rate cut could lead to lower interest rates on mortgages and other loans. So if you've been toying with the idea of buying a home or refinancing your current one, now might be a good time to shop around and see what's out there.
On the flip side, if you're relying on interest income from savings accounts or CDs, you might see those returns shrink a little, right?
That's right. It's a classic trade-off. Lower interest rates are generally good news for borrowers, but not so great for savers. It's all about finding that balance and figuring out what works best for your individual circumstances.
And we can't forget about the stock market. Investors are always trying to predict the Fed's next move, which can make the market a bit like a roller coaster at times. What are your thoughts on that?
The stock market is notoriously unpredictable. It tends to react favorably to lower interest rates, at least in the short term. It's like a shot of espresso for the market, giving it a quick boost. But, as we've discussed, there are so many other factors at play that it's impossible to say for sure what the long-term impact will be.
It's a good reminder that diversification is key, right? Don't put all your eggs in one basket.
Absolutely. And always stay informed. Never stop learning. And don't be afraid to ask questions. Those are the best tools you can have in your financial toolbox.
Words to live by. And speaking of questions, here's one to ponder as we wrap up this deep dive. The Fed has a lot of levers they can pull to try and influence the economy. But what happens if those tools aren't enough? What if we encounter an economic challenge that requires a whole new playbook, something completely unexpected? That's something to chew on. For now, we'll leave you with that thought. Until next time, keep learning, keep asking questions, and we'll catch you on the next deep dive.